So, hello everyone. I'm glad that we have a diversified panel of speakers today for the finance panel. International banks, Greek banks, non-bank financiers, and advisors. So we will cover a variety of topics and finance from traditional to sale and leaseback, capital markets. And let's start with traditional bank finance. So it's mainly a question for Hugues and Vassilios, I will say, whoever wants to start. So is traditional bank finance gaining increased traction within the shipping sector? And what are the key drivers behind this shift in market preference? Who would like to start?
Sure. Can you hear me? So is traditional financing gaining traction? I think traditional ship financing will always be there. It's going to be part of the capital structure. It's going to be attractive, of course, depending on what the project is. There are multiple ways to tap it. You have bilaterals, you have syndicated loans, you can do various ECA financing. So all of that comes into play. It is attractive. Of course, it has multiple things that one needs to take into consideration. The classic sort of how far can you go in terms of LTV and contract value and how it amortizes depending on whether it's OECD, non-OECD, or of course traditional bank financing. So therefore, is it gaining traction? I think it's exactly where it always was. It is a option that many of the shipping corporates have. Ultimately, it's how you utilize it, how you actually put it and blend it in your capital structure is something that one consider. Of course, it's subject to cost and how it fits with your strategy. It has there are many parties who are involved, many banks. You have, of course, the US lenders, you have the Europeans, and each and every one has their own, sort of sweet spot. So therefore, trying to find consensus on how you put them in the capital structure is one for, of course, the management of the corresponding entities. But is it gaining traction? Yes, I think it is. Is there capacity out there? Yes, there is, and it's all subject to, of course, the corresponding project and, of course, the relationships that the corresponding shipping entity has.
Thank you. Hugues?
Can you hear me? Yes. I fully agree with what Vassilios said. I think I would add at least what we have experienced for the past 12 months is, clients have had probably less need for capital due to high asset values. And we feel the finance teams have been focusing a lot on optimizing the balance sheet and push down the cost of debt. And I think if you look at the horizon of capital providers available out there, I think the banks are still those that can offer the tightest pricing. So I think that's been the driver why maybe banks have been a bit more active lately. And I think also geopolitics. A lot of local owners and globally have decided to refinance, certain leases arrangement by fear that they would eventually trigger some additional operating costs, and I'm referring to port fees. And I think that uncertain geopolitical environment has certainly brought interest back to, I would say, local banks, Western banks, that I think remove that additional risk spectrum for the clients.
Thank you. Moving now, my question is for Theofanis, because it's about Greek banks and their competitiveness. So it's what factors are enabling Greek banks to offer increasingly competitive shipping loan terms compared to international lenders?
Good evening to everybody. I think what has changed in Greek banks are two or three things the last 5 years. The first is deal size, where the Greek banks were not, let's say, competitive with the international banks. It was deal size, it was pricing. We're doing better on deal size. We have been a bit aggressive on pricing. And because on my right is Vassilios, I don't know the cost of funding in dollars of Citi, but for the Greek banks, we have to be careful not to give loans lower than the cost of funding of Citi. So it was deal size, it was proximity to decision makers. I was looking at some statistics. Back in 2010, the first banks that not stopped lending, contracting their shipping portfolio were the Greek banks. The foreign banks had the same effect in 2014. This is not because we are clever, it is because we are close to the decision makers. This has helped a lot the Greek banks. And as soon as the Greek ship owners show deal size, pricing, service, commitment, and please don't underestimate that in the Greek banks, National Bank of Greece being here for 60 years in shipping, have also teams with very good shipping experience. Teams that are doing shipping for the same officers for 20 years, 25 years. And this is very, very important. And for the relationships, and for knowing the market, and for reacting fast. So, the last thing is something that IMF said yesterday, reviewing the Greek banking system, is the strong balance sheets. And all the Greek banks have very strong balance sheets. So there is liquidity also on the banking side. Shipping being a cyclical business always needs attention and be alert. But at the same time, it's a good place to put a bank their money if they do it in a qualitative and not very aggressive way. I think these were the main differentiator, but because shipping is getting more and more expensive, but back in 2019, I think we were the only Greek bank doing LNG. We did another in 2020, and now the market is fine. That just to give that the deal size and the pricing were very, very important. Thank you.
Thank you. Moving now to non-bank financing. So a question for Haris and Nick. Has the role of non-bank lenders evolved further in recent years? And what advantages or challenges do they present in today's market? Who would like to?
Good afternoon. Thank you, Alexia, for the question. And before I start, I want to congratulate Kevin and Mia for picking an amazing location, because I think that's why the room is still full. If not for their interest in finance, of course. But joking aside, I'm glad that you called it non-bank finance, because typically we called alternative lenders. And I keep on saying it's not alternative anymore, it's mainstream. And it's mainstream because if you look at the numbers, leasing, which is what we do as Neptune Maritime Leasing, probably represents a very large, maybe 30% of the global business today. So it's not a product anymore which is unknown or questionable in the eyes of the shipping professionals and our clients, but it's a product which has become mainstream. And admittedly, this is thanks to the Chinese leasing houses who pioneered ahead of others to build a book of about 100 billion. We actually did a count a few weeks ago with my team who's over there, and it's about 100 billion. And approximately, we counted 1,600 ships, and these are expensive ships. So it means that basically owners are accustomed to dealing with leasing. It's another financial instrument, which in our eyes was a fantastic method when we started about 4 years ago to disintermediate, if you will, the banking business and also attend to, let's call it, the unattended ship owners, the smaller to medium-sized ship owners, that the banking system was living by the wayside. Now, of course, this is a dynamic market, and things are changing, and banks, of course, are back with a vengeance, which is great, because the needs of the industry are great as well. We're talking about a couple of $100 billion a year of new buildings. And, you know, there is, we call it the trillion-dollar opportunity, because in the next 20 years, as we know and evidence every day, we need to, you know, go through the energy transition, and that requires tremendous resources. So I think one of the resources that definitely is going to be there to help the owners is going to be leasing. We've been very fortunate to have a very warm welcome by our clients. By the end of the year, we'll be approaching $1 billion in origination since we got established about 4 years ago. And that's a testament to how well accepted the product is. Not to mention how well we do as a team, of course, but that's a different story. So I'm going to stop there because...
Thank you.
I would like first to congratulate Kevin and Mia. I would like to echo Harry's comments also on the venue, and it's always a pleasure to be among such esteemed guests. I would say, yeah, definitely, you know, leasing an alternative has become mainstream, you know, and it has, let's say, in a fashionable world, democratized the access to capital and finance. And, you know, the startups, the small to medium enterprises, the niche markets, and he has done that in a way to be very quick and very commercial. And we have seen, let's say, projects on that side that in other times it wouldn't be attended for. And that's definitely something to look for, and it's always great to have that. I mean, we see a plethora now of instruments and financiers and ways that, you know, assist what is definitely, you know, required. You know, finance is always required from our capital-intensive industry.
Thank you. Yes, at first they were reluctant because there was this ownership issue, but now it's, I think now companies don't mind if it's pure finance or the sell and lease back route.
In fact, if I may add, because you touched upon an interesting point, the ownership issue is not a real issue because the assets are still in the balance sheet of our clients. What we show on our balance sheets is net present value of leasing payments. So we're not the owners of the asset goes back to the owner at the end of the lease period. So this is a financial lease product, nothing else.
And they are, of course, operating it, so they are operating the ship. They are moving now to capital markets. So it's a question for Hugues and Vassilios, if they want to answer. Is how, first of all, let's deal with the Nordic bond market. How is the Nordic bond market shaping financing strategies for ship owners in 2025? Particularly in terms of flexibility and speed of execution compared to traditional bank loans? What lessons can be drawn from recent successful placements?
Thank you, Alexia. If you look back around 20 years ago, when the Nordic bond market sort of started, it was a very small market. It's a $10–15 billion equivalent of volumes, and that was primarily a product available to the Nordic clients. You know, ticket size were fairly small, probably below $100 million equivalent. You know, fast forward to 2025, this is a market representing $65 billion and now has a size that becomes a lot more relevant to the big UK and US hedge funds. So what does that mean? That means the appetite currently is extremely strong. I mean, generally speaking, across the world, there's a lot of appetite for fixed income, but particularly the Nordic market has a lot of interesting elements for shipping companies. It's a very flexible tool. It doesn't require any credit rating. You can access the market within 4 to 6 weeks from, you know, preparation of the term sheet to the funds being credited to your account. The documentation is very light, but, you know, adequately protecting the issuer and the investors. So, you know, it's a lot more easy than the US bond product. And I would say we've been discussing, you know, geopolitics across the panel, our advice to our clients for the past 15 years has been diversify your sources of capital. And I think the panel is a good example that obviously the market has developed a lot, and there's now a vast array of products available to our clients. But the bond market is slightly different in the sense that it's not always available, particularly for first-time issuers. Now the market is widely available, even for first-time issuers. Actually, first-time issuers are driving new volumes at the moment. And typically, the market has shifted also from mainly Nordic issuers to international issuers. You know, more than half of the issuers are international companies, and more than half of the investor community is also international. So I would say, look, don't necessarily wait until you have a project to finance. You know, view this as offering additional flexibility for your balance sheet. And we've been very active in this market for decades, and we'd be happy to have any discussions with any company interested to discuss that product.
Thank you. Would you like to comment?
Yeah, I mean,
the US,
it's a totally different product. Of course, it has very same characteristics. Of course, it has different requirements. Now, the US debt capital markets, of course, require rating. It require which that's fundamentally the driver of the additional work, and then it requires an OM. At the same point in time, it gives you access to a pool of capital which is always there at a price. What we have seen, and it's not about, again, in many occasions, like with Harry, these things are all complementary. They're all part of the capital structure. It fits specific things. It requires a specific size. So below $250 million, for example, US investors usually don't particularly like that. Why? Because it's a lot of work for a limited size. It also has very liquidity in terms of how the instrument can be traded. But what it does is that it's always there. It's always open. It has never been shut at a price, of course, in direct contradiction to what we have seen in the past. And maybe this time, if the markets ever turn, it will be different. But for example, because at least what I have witnessed is the Nordic bond market used to open and close for all participants at approximately the same time. And therefore, what did you have? You had a wall of potential maturities, which if the market was sour, it was a bit difficult to refinance, especially when you're in bullet structures. So I think that's a difference between the US and the Nordic bond route. I think, of course, additional work. In the past, many owners would have a very significant sort of issue with regards to where the rating of an S&P or a Moody's versus how their banks would view that rating. So therefore, you would say, okay, my bank views me as investment grade, Moody's will rate me as single B minus, whatever that is. And of course, you have structural subordinations and stuff like that. So that is something that the banks can no longer, from a regulatory point of view, point to that. It's an additional data point where Moody's potentially rates you, but not a requirement to effectively peg that to it. So we have seen issuances which we have led, like Golar and many others, where we have priced significantly within where a Nordic bond would trade. And that's because of the availability of capital which is there at the moment. The investors are hungry for assets, and therefore they can be placed with the right story. And I think increasingly will play a significantly larger role in the potential projects that are out there. The last thing, which I think is extremely important, is of course a Nordic bond has maintenance covenants, a US bond has incurrence, and it's totally different. It allows significantly more flexibility. But of course, a lot of work, and again, complementary. I don't think the two instruments compete against each other. In some companies, maybe, but so pros and cons.
Thank you.
I just wanted to add something here, because I agree with you on the complementarity issue. However, I want to make a note that In fact, the bond market is open now. There's yield compression. Companies are rushing to issue bonds. Bonds are still indebtedness, and that means you need to return the money at a certain point in time. And we have a pro-cyclical indebtedness accumulation right now, which means we issue bonds at the peak of the market, and typically, as they are bullet instruments, you need to be able to generate a growth rate that is definitely above the bond yield in order to be able to support and make the repayment at a certain point in the future. And as we're at a cyclical peak in asset values, there is a potential or a likelihood that at the time of the refinancing, there may be an issue as values have come off. So definitely, I would advise that the bonds are an interesting instrument as long as you have very specific growth prospects, number one. And number two, if it's not the only instrument, debt instrument or capital instrument in your portfolio. And therefore, a combination of different instruments and amortizing ones for that matter in good markets are essential.
And this is usually the case, right? There is a combination. It's not just... Usually that's the case. They have a combination of different types of debt.
Yeah, I wouldn't suggest that it's for a startup, or a small company. I mean, if you're a large company with a significant balance sheet, a lot of equity, and the sort of a bond indebtedness is just a part of your capital structure, then definitely is an instrument you need to look at. Otherwise, I think it's a difficult instrument to handle. Leasing is much better.
We got the point.
If I may add, to Harry's note, it's you have to be very disciplined and careful not to turn into an instrument of mass distraction at the expiry.
Yes, I mean, look, I agree. First of all, I agree. I will agree with Harry. Leasing is the answer to every problem. Yeah, absolutely. I think also no worries. But at the same point in time, I have to say, Harry is correct to point that out. You need to have a plan. You need to have a strategy. It cannot be that you just do it, but it also has additional. If you're careful in planning, if you know what you're doing, if the cash flow is there, then ultimately, especially for a cyclical industry, it can also be extremely beneficial. Why? Because a bond instrument, you can actually buy it back at the prevailing bond price at the time. So I have, for example, clients which once you accumulate, when you buy that back at a discount, ultimately the cost is significantly less than the coupon. It could also be in negative territory. So therefore, once the market turns, if you have the cash flow, if the bond is trading, then you can buy. The investors love it when you buy and you shore up and you show belief in your project and your company and everything else. So pull it all together, it could be beneficial. But again, it's not something that you do it without being able to support it, right? It's important.
Thank you. So turning then back to traditional bank financing, Fanny, how do you think banks are structuring their shipping loans to attract new building and second-hand vessel financing, especially in competition with sale and leaseback and non-bank alternatives? Non-bank mainstreams, sorry, not alternatives.
Alexia will make a bridge to the previous disagreement with a couple of perhaps 3 questions. When a ship owner wants to exit from his private equity partner, who finances him? The bank. Who is financing the leasing platforms? It's called back leverage, the bank. Who is financing private credit equities and platforms of private equity for shipping? The bank. When the US capital markets are having a deep discount on your NAV and you cannot raise money, who is there? Your relationship bank. And when the bond markets are closed because the outlook of your rating is negative, who is there? You don't know the answer up to now? The bank. So, this is an indirect way to discuss how the bank is facing the leasing, the private equity, the US capital markets, the Nordic capital markets. There's only way. We're patient. But I think I agree both with Harris and Vassilios. There is room for everything. All the, let's say, financing instruments being leasing, Chinese leasing, private equity, US capital markets, Nordic capital markets, Greek capital markets, because don't forget that a couple of companies had Greek shipping bonds at very good rates. It's good for shipping, it's good for shipping market, and there's room for everything. I will tell you, and it's complementary, and one is helping the other. Perhaps you know, it's not a secret, when there was the issue of the Chinese leasing, many Greek owners, because they decide fast, they decide to refinance, I don't know, for Citi or whatever, but to refinance in the Greek market. We were fast, I mean, I assume other also Greek banks are participating in this game. We're fast, there was not a question of quantity, of course we're not talking about 100 billion, but we're there to refinance fast, solving the problem for them and going forward. That, for me, that doesn't mean that the Chinese or the Chinese leasing market is dead, no way. I think it will continue to grow. And as many instruments of financing we have in the shipping finance market is good for everybody. It's good for the industry, it's healthy, and it's something that I don't consider competition. I consider it as a rational growth of financing market that other industries they have. Don't forget this. It's not something that we invented, okay? A corporate can have a leasing, can have capital markets, can have bank financing, and I don't understand why shipping cannot. So we're in a happy period that our customers have multiple solutions, and I think also keeps us disciplined in many ways. Thank you.
Thank you. So it's when someone asks who you're going to call, we know the answer.
I was thinking exactly the same as music background, to be honest. You beat me to it.
So I'm sure also Hugues and Vassilios will agree with what Fanis has said about the banks, the relationship banks.
Look, I'll echo what Fanny said, and it's all complementary. It's all subject to the strategy of the corresponding corporate as to how they want to put together their capital structure. Fundamentally, we are in a place where relatively all the markets are open, and therefore one needs to pick and choose what suits better the corresponding strategy and how it works. Of course, the relationship banks are there to support and be there across the board, whether it's on good markets, bad markets, or whatever that is, with specific terms. But again, I do not see it's not a competition. In some projects, of course, you may want the project more, but at the end of the day, it's all coming together as the corporates, by the way, are growing. Now, yes, if you're only in 1 vessel, 2 vessel, 10 vessel territory, and you're not going to be growing, then potentially, okay, you may be sort of like, this is it, this is where. But at the same point in time, as the corporates are growing significantly, the needs are growing also.
Thank you. So we only have 5 minutes. So let's go back to sell and leaseback. And also Chinese sell and leaseback. So for Nick, question, how does Asian finance currently fit into the global financing landscape? Are certain regions or institutions still leading the way? Are Asian leasing models such as Chinese sale and leasebacks and Japanese JOLCOs still offering superior tax and amortization benefits compared to Western bank loans?
That's Alexia. Yes, I mean, Asian finance remains one of the cornerstone of ship finance. We've seen the evolution for the last 10 years. It started as alternative and became, for niche markets, and then became, more and more, echoing traditional terms and just competing or supplementing the finance provided by traditional banks. So if you're thinking of Chinese leaseback, sell and leaseback, usually you're thinking of big tickets, high LTVs, longer tenors, longer profile, which is still the same. And actually, even more competition has pushed them to more competitive terms, very, very good margins, and very, let's say, commercial structures. Equally on the Japanese side, JOLCOs, despite the challenge a couple of years back on, let's say, in terms of regulation, they're back with a vengeance. It still provides superior, let's say, tax benefit for the equity player, and definitely it's very good pricing for the owner that has the patience, let's say, to remain long-term in its asset. So Asia is definitely, still going strong despite the misconception, despite the USTR challenges. We've seen more and more, which was probably not anticipated. We've seen more lessors coming, Chinese lessors coming into play, the ones that have seen bigger lessors getting a big chunk of the market, and they were, let's say, very good in aviation and everything. Then they say, well, we want a piece of the action. So still going strong, and they're reshaping. They are changing the product, and they're providing to owners a big plethora of solutions.
Thank you. Harry.
I think that's correct what Nick said. However, you all evidence what we're going through right now, which is a very uncertain environment because everything moves at the same time. There's a geopolitical uncertainty, there's regulatory uncertainty, financial potential uncertainty. And in the past years, we have seen that companies were looking at three elements: the environment, affordability, and security, in that order. So everybody was talking about ESG, 2050, IMO, etc. Right now, and in the past year, I suppose, we now look at the inverse order, which means that people are concerned with security, affordability, and then the environment. So they're all important, but the order of attention has changed. And that means security has two elements. First is security of supply, and security and protection from geopolitical upheaval. And that's where we, as a European-based shipping company, we can sit between the two worlds and navigate the straits. It's also in terms of availability in what seems to be a cyclical peak. And whether we like it or not, banks are pro-cyclical by nature to a certain extent, although we would love to see banks being counter-cyclical, and that's what all banks are saying. When I was a banker, I was saying the same thing. The reality is that regulation forces banks to be pro-cyclical. And the question is, what happens when the market turns? And with the exception of, a lot of banks, here in the panel that have stayed throughout the years, we have seen that banks are entering and exiting in adverse market conditions. We used to call them the tourist banks in the old days. So the second issue is the affordability. And when it concerns the affordability, obviously there are certain areas of the world that are able to generate low-cost funding for owners, but that, of course, doesn't come with no frills attached. We now see what the repercussions of geopolitical games are as far as that one's concerned. We have clients today that are Chinese companies and Japanese-owned companies that are coming to us to look for leasing solutions, which is telling because everybody thinks of security first and then the affordability. Of course, the environment is everyone's agenda. We are very eager to see what's going to be the outcome of the IMO discussions and take it from there.
Thank you. So, because we only have 28 seconds. No. So last question, whoever wants to answer with one word. Looking ahead, what trends do you expect to shape the future of maritime finance over the next 12 to 24 months? Trends?
As far as I'm concerned, I can speak on behalf of Citi. For us, the element and the most important element of all is, the corporate. And we are corporate financiers. We take, of course, security of the corresponding asset. So it's not about LTV. It's about strategy. It's about looking forward. There's a lot of ups and downs that are coming. There is, a very crucial vote happening tomorrow in London, which is going to impact all of us. So I think about the same point in time, the opportunity is enormous. The fleet is the oldest it's ever been, regardless of what the size of the order books are. It's the opportunity that is within grasp, if someone can grasp it, is very, very significant, and therefore, and we all find ourselves in a time where capital is available. So here you go.
Thank you. Anyone else who wants to answer this? Hugues or Fanis or Nick?
Alexia, finance is like water. It changes shape. So, and it finds its way to the end user, and we know, as we said earlier, it's a very capital-intensive industry, and solutions are already there. Christopher referred to that earlier. Chinese leasing is evolving. It has solutions, meeting the geopolitical challenges, and so is everything else. We've seen the emergence of the Greek banks coming back strong. Actually, they're probably the biggest challenge to the Chinese lessors in terms of pricing rather than geopolitics. And we've got now a plethora of instruments, bonds, capital markets, mortgage, Chinese leasing, synthetic leasing, ECA banks. So, I think the big question is how the new IMO and the other geopolitical tensions will probably influence the Western banks. Are we going to see a shift from green and sustainability-linked loans to a more, let's say, traditional business-as-usual loans? How is this going to shape? Because I think this is what we're witnessing as we speak.
Thank you.
Can I just one more thing, just very quickly? 1 minute?
Okay.
There is, we all read about the Draghi report and everything, talking about industrial another type of revival in European economy. One area which is very high up in terms of my occupying my sort of mind right now is the opportunity that exists in using the tremendous capital expenditure of the 20 years, of the following 20 years in shipping, which is in trillions of dollars, to increase the footprint of the shipping industry in our local economies. In Europe, and of course in Greece, because Greece has the largest fleet in the European Union, 50% of it, and we see very little output coming directly through our GDP. And that's an area that I think we need to think carefully. We're doing that in the auspices of a non-profit organization called Convos. We have a conference, not competing with Kevin's, on the 28th of November at the Megaro Karadza of National Bank of Greece, where we're going to talk about these things and others that Convos is involved in. I welcome you all to join us there. Thank you.
Thank you. Thank you very much.